What if I told you the market's biggest fear right now is not the stock chart? It's a ceasefire that could break at any moment. Because that is exactly the kind of setup traders are waking up to today. Oil just jumped, then cooled off. Risk sentiment got shaken, then partially recovered. And somewhere in the middle of all these, Indian markets are trying to break out on the strength of domestic money, while global macro trends keep throwing fresh volatility into the mix. Good afternoon and welcome back. The big headline is simple, but the implications are huge. The fragile US-Iran ceasefire is still holding even after a fresh flare-up of violence in the Persian Gulf. That sounds like geopolitical noise, but for markets it is anything but noise. When tensions rise near the Strait of Hormuz, traders immediately start pricing in one thing: oil supply risk, and that means higher crude, hotter inflation expectations, and more pressure on the broader market sentiment. That is why oil prices spiked sharply, then eased back a bit. But here's where it gets interesting. Even when oil pulls back, the market does not fully relax. Why? Because institutional money knows this kind of headline can come back fast. One more missile, one more shipping disruption, one more escalation, and suddenly the entire macro setup changes again. Now, zoom in on India. Indian equities are trying to stay bullish, and the setup is being driven by a combination of domestic inflows, earnings strength, and a surprisingly resilient rural economy. The Nifty has already seen a strong rebound, and when momentum builds like this, retail investors usually chase the move, while institutional investors quietly decide whether the breakout is real or just another short-term bounce. But here is the real game changer. If oil stays elevated for too long, that bullish setup gets tested. India is highly sensitive to crude, and that means every move in Brent and WTI matters. Higher oil can pressure the rupee, widen import costs, and make the Reserve Bank's job harder. So even though the market is upbeat now, traders are watching this oil shock like hawks. At the same time, there are pockets of optimism. The rural economy, for example, is showing more resilience than many expected. That matters because it supports consumer demand, and consumer demand supports earnings. If farm income holds up, if reservoir levels stay healthy, and if non-farm income keeps flowing, then a lot of domestic names can keep trading with a positive bias. And this is the part smart investors are watching closely. The market is not moving on one story. It is moving on several at once. On one side, you have geopolitical volatility and oil. On the other, you have strong domestic flows, earnings momentum, and selective sector strength. Then there is the tech angle. Apple is reportedly exploring more US-based chip production, including talks with Intel and Samsung. That is another signal that supply chains are still being rewritten. For markets, this is about more than one company. It reflects a broader macro trend: reshoring, supply chain diversification, and the push for strategic manufacturing control. Meanwhile, a new wave of market themes is emerging in India itself. SEBI is looking more closely at AI-related risk, which tells you regulators are starting to pay attention to the speed at which new tools can impact financial systems. And in the services space, Urban Company's fast household help model is drawing attention because investors love one thing above all else: scalable growth with low capital intensity. Now, keep an eye on stock-specific action too. In India, options traders are already reacting to political momentum, infrastructure bids, and corporate earnings. That means names linked to logistics, ports, housing, and industrial execution could stay active. At the same time, the market is clearly separating winners from laggards, and that is where volatility creates opportunity. So, what should investors watch next? First, crude. If oil keeps climbing, expect pressure on risk appetite. Second, the ceasefire. Any renewed escalation could trigger another knee-jerk move in markets. Third, whether Indian equities can hold their momentum as foreign cues stay mixed. Because right now, this is not just a story about one headline. It is a story about liquidity, sentiment, and how fast traders are willing to pay up for growth when the macro backdrop is unstable. And that, in a nutshell, is why today matters. If you found this breakdown useful, Subscribe to the channel, press the bell icon and stay tuned, because the next market move may come faster than most people expect.